Inside this notebook right here, I have a ton of different notes to self that I've written over the past many years of running my stock market portfolios. There's probably more than 60 individual notes to self that I have in here, but we're gonna go through 15 in this video that I think every stock market investor should hear to help you bulletproof your portfolio and make your gains sustainable over time. If you're looking to scale your stock market portfolio to multiple 6 figures or 7 figures plus, this is a must-watch video. Let's jump into the first rule. The minimum time horizon with the stock should be 1 year. It's going to be a lot easier to figure out where a stock is likely to go over the next 1, 2, or 3 years than it is to figure out where a stock is going to go over the next 1, 2, or 3 months. In the short term, sentiment drives stock price in a major way. Over the long term, it's based on business fundamentals and where earnings go and where margins go. If over the long term, earnings are trending positive and margins are trending positive, then the stock price is also going to trend positive. If in the long term, earnings are trending negative, margins are trending negative, revenue is in decline, and the balance sheet is getting in a weaker and weaker position, the stock price is going to trend downward. But over the short term, the next 1 month, 3 months, 5 months, no one really knows where stock prices are going to go. It's based on broad market sentiment, and so many different things can make stocks move big time to the upside, big time to the downside in a very short period of time. And normally those short-term moves are not fundamentally based. Next rule here is very simple, but extremely important to building your stock market portfolio, especially in the early days. And that is to contribute new money to your stock market accounts every single pay period. This has to be a priority, especially, like I said, if you're in the early stages of this. From $0 to your first $100,000 in the stock market, one of the main driving factors of how quickly you're going to get there is how much money you can contribute to your stock market portfolio. Once you have a lot of capital behind you and you've built up a large sum of money from your contributions, then the percent gains are going to end up taking over in terms of the growth of the portfolio over time. But it might take a few years in order to make that happen, so it's vitally important to contribute new money every single pay period. All right, next one up here. The management team of a company, specifically the CEO, the COO, and the CFO, in that order, matter a great deal to a business's success over time. If you have a star-studded management team that has a track record of bringing new growth and innovation to a business and is able to position their business correctly throughout the different stages of a business life cycle, that's going to lead to extremely strong fundamental growth over the years. And we know if we have strong fundamental growth, we typically have strong stock price growth over the long term. So become familiar with the management team and especially the CEO and decide if this is someone you trust to run a business that you're owning, because after all, you are a very tiny part owner of a business when you buy a stock. I got a comment on a recent YouTube video talking about this exact thing with 2 different CEOs and 2 different businesses and how they've led to the success or failure of the stock price. Check it out. This person says, I bought NEO and SoFi at the same time. Whilst these companies are in different sectors, the difference between disaster NEO and success SoFi has a lot to do with the CEO. Noto, the CEO of SoFi, is great. The NEO CEO is one of the worst CEOs on the planet. Check out the difference in stock price movements of these 2 stocks over the past few years. All right, next one. As a rule, stay away from unprofitable stocks. They are inherently far riskier than profitable stocks, and they're way more difficult to value. One of the major ways we value stocks is based on how much net income they bring in on an annual basis and comparing that to their market cap. If there is no net income and they're a money loser, it's much, much more difficult to value those stocks. The only exception here is if you want to buy an unprofitable stock, make sure that you can see a very clear path to profitability over the next few quarters, not over the next 3 to 5 years. We don't want to hold a stock that's unprofitable for multiple years, but if you're buying a stock right before they flip to profits and you can very clearly see that they're about to hit that, or even the management team says, hey, we're going to hit profitability in, let's say, Q3 of 2025, that can be fine because you know they're not going to be unprofitable forever and the story is getting better and better and better, and you can use forward valuation metrics like the forward PE when a company is just in the early stages of flipping the profitability corner. All right, next rule here. Make sure you wrap your head around the business and what they do, the business model, how they make money, what their products are, and how those products are superior to their peers before you ever dive into the financials or the valuation metrics or analyst future or projections. Make sure you understand what the business is so that if you buy that stock, you understand what you own. You understand the risks inherent in that business model. You understand how they make money, what macroeconomic factors could affect how they make money, etc. All right, next up here is you gotta let the winners run. If you have a stock that you're up 30 or 40 or 50% on, it's not necessarily time to cash that position. Some stocks, like a turnaround play or a value play, maybe that's the case. But with your growth stocks specifically, let those winners run. I've talked to many people over the years who say, yeah, I took my profit out of X, Y, and Z stock when I got a 50% gain, or when I got a 100% gain, or even when I got a 200% gain, and they ended up missing out on way more gains from there, potentially another double up or another triple up. A gain specifically with growth stocks can be absolutely insane. And for you to take a 50% profit, although that's respectable, it's nothing in comparison to a 250% return, a 350% return, or even way more than that. I personally have multiple stocks in my portfolio right now that are up more than 1,000%. If you like this type of video and you like hearing these notes to self that I've written over the past many years of running my portfolio, consider checking out the Patreon. I actually shared a total of 42 of these notes to self through 2 posts called Rules for Modern Long-Term Investing. I got part 1 and part 2. Each one of them has 21 of these rules in there. Check out the Patreon to get access to that. I also recently did a Big Bear AI analysis. This is ticker BBAI. It's a very hyped AI stock that's being compared in a big way to Palantir. I go through an analysis on there and whether or not I think this is the next Palantir. So get those Rules for Modern Long-Term Investing, those 42 notes to self, and Big Bear AI analysis, and all the other posts on there, community chat, etc. Join the other 186 members in there with a pinned comment down there and the first link in the description. All right, let's get to the next rule. Any new money made from your day job should go straight into investments to avoid any unneeded lifestyle inflation. If you can continue living on what you were living on before you got that 10% raise, and then you put that extra 10% of your income into your stock market portfolio, you're going to be able to grow that pie even faster. Early on in your investing journey, that new capital is going to be a lot more impactful than once you're at multi-6 figures or 7 figures. Putting money in at that point doesn't move the needle that much, but at lower portfolio values below 6 figures, adding extra money is going to be a big needle mover for your portfolio value over time. All right, next, no investment decision is complete without a quick dive into the balance sheet. Once you understand how to read a balance sheet, it does not take long at all. You look at the assets, you look at the liabilities. If they have more assets than liabilities, they're in a pretty good spot. If they've got a lot of cash on hand in comparison to their liabilities, they're in a good spot. If they have a ton of long-term debt, that's probably not a good thing. If they have a ton of short-term debt, that's definitely not a good thing. And then if they have lots of long-term debt and short-term debt, very few assets and almost no cash on the balance sheet, that is a weak balance sheet. We want to have way more assets than liabilities. If that's not the case, you've got to take that into account when buying a stock. A bad balance sheet company is a risky company. They might have to raise more capital, which dilutes shareholder equity, which hurts your overall return. They might have to take on more debt. In order to service that debt, they're going to have to take some of their revenue to do that, which is going to hurt their net income over time. And with a company who has a high debt load, if we go through a high rate environment time, like we've seen over the past few years, rates have been higher than they've been in many, many years. It's going to be more expensive for them to service that variable rate debt. So that's a much more risky company that's going to see a lot more downside in a higher rate environment time, which is typically when stocks are getting hit already. Even if everything looks perfect outside of the balance sheet, you've got to take a quick look at the balance sheet before you ever buy a stock. Next rule here, don't sweat the short-term movements in a stock, especially in the first few months after you buy it. If you buy a stock and it goes up 20% in a very short period of time, it doesn't mean you picked the best stock ever and you're a genius. On the flip side of that, if you buy a stock and it drops by 20% in a very short period of time, it doesn't mean you're a failure and you picked the worst stock ever. Those type of fluctuations are pretty regular, especially with a higher growth company, a higher beta company that moves more than the market. So don't sweat the short-term movements. Make sure you're staying long-term focused. If it pops by 20%, stay long-term focused. What was your time horizon? Was your time horizon 3, 4, 5 years? Did you expect an 80 to 120% return? If so, don't get too excited about the 20% return and want to take that profit and book the profit so quickly. If it drops 20%, don't freak out. That can be a blessing. If you like the stock at 20 and then it drops to 16 and nothing's changed about the fundamentals, it's a better value now. You can pick up more shares and get more value for your dollar. Next up, put the high majority of your portfolio into high conviction growth stocks that you have a 3 to 10 plus year time horizon with. Those should be the core of your portfolio. To have a few value stocks, a few dividend stocks, a few turnaround plays, and a couple of spec stocks is totally fine and probably a good thing for overall returns in your portfolio. But the core of your portfolio should be those growth stocks with a 3 to 10 or more year time horizon. Next rule, be sure to have a cash position in your portfolio at all times. My personal minimum is a 5% cash position in my portfolio at all times. Market sentiment can switch so quick and stocks can drop in the snap of a fingers. Look at Q1 of 2025. In 6 weeks, the S&P 500 dropped by roughly 19%, and some individual stocks got hit way harder than that. Some were down 30%, some were down 40%, some were down 50% in that time when the index was down roughly 20%. If you have a cash position, you're able to take advantage of those dips and buy at heavy discounts on those fear-based drops. I was buying in April at the April lows when we had all that tariff fear. If you didn't have a cash position ready to take advantage of those dips, you missed out on some incredible pricing in the April lows. Those type of crashes are going to happen again. It is inevitable. You want some cash around to take advantage of those dips so you can increase those high conviction plays that you have on those fear-based drops. Those drops were not fundamental based. Not all stocks in the stock market just got their earnings cut by 20%, their revenue cut by 20%. Nothing like that happened. It was all fear-based. What did we do after that drop? We soared higher. We hit all-time high after all-time high multiple weeks in a row after that. Now, the next rule ties in perfectly with the one we just talked about, and that's to buy in all types of markets. In a bear market, you should absolutely be buying heavier because you're getting a heavier discount on those shares, and there's deals out there left and right in a bear market. But in a bull market, still be a buyer. Just buy a little bit lighter in bull markets and buy heavier in bear markets. It's going to treat you very well over time. Next one, if a stock's fundamentals turn south and you don't see a clear turnaround, it might be better to just take your losses and exit the position. My most recent example of this is with Zillow stock a few years ago. My average cost per share was about $91 per share on Zillow stock. They exited their home buying and selling business called Zillow Homes, and the stock dropped extremely heavy from $103 a share all the way down to $56 a share in just 3 weeks. And the stock continued to trend down after that. I got out during that crash because I did not see a way for them to get their net income and their revenue and their growth rates back to numbers like they had with that Zillow Homes segment. That was leading to crazy, insane growth for them. And they just announced out of the blue that they were exiting the Zillow Homes business completely. And if I was to have held Zillow stock all the way until today, I would still be down on my shares. Sometimes it's better to just cut the losses, but this is only for a stock where the fundamentals have turned south and there's no clear turnaround plan laid out by the management team. This is not for a stock who got a fear-based drop, but the fundamentals are unchanged or even strengthening. That type of drop is a buy the dip opportunity. Okay, the next rule is about dividend stocks. I believe a well-balanced portfolio has a few dividend stocks in there, as well as those growth stocks, value stocks, and maybe a couple speculative stocks. So for dividend stocks, make sure that the EPS growth rate is outstripping the dividend growth rate. If your dividend stock has a growth rate of 10%, you want that same stock to have an EPS growth rate above 10%, maybe 12 or 14 or 16 or 18%, something like that, so they can retain a portion of their net income to put into R&V to continue to innovate, to continue to grow their share in the marketplace. Ideally, they raise that dividend each year, year in and year out, and your yield on cost goes up and up and up and up. That's the dream for a dividend growth investor. All right, now the last one up here might be one of the most important on the entire list. Before ever buying a stock, make sure you do a deep dive on the 10K and the 10Q. Those are found on the investor relations page. So look at the most recent 10K, look at the most recent 10Q, and take notes on the following things: key metrics, takeaways, strengths, risks, and worries. If you take notes on all those things, you understand the business model so that you know what you own, you wrap your head around the revenue growth rates, net income growth rates, margin expansions, innovation opportunities with the stock, and you take a quick look at the balance sheet to make sure they're in a strong position in terms of assets versus liabilities. The odds that you pick a bad stock once you've gone through all that research work are extremely low. They're not zero. Things can change fundamentally very quickly for companies, and the market will sell them off very quickly. So there's not a 0% chance that you'll pick a bad stock if you're doing all that research work. But the more you know about the business that's behind the stock, the better off you'll be. If you want to see roughly 30 more notes to self that I've already posted on the Patreon and the part 3 that I'm going to post here in a few weeks, go ahead and join the Patreon. I'll put it as a pinned comment down there in the first link in the description. Let me know in the comments below which one of these rules hit home the most for you and which one you had to learn the hard way. Definitely one of my favorite parts of posting here on YouTube is having some conversation with you guys in the comment section. I'm looking forward to reading those. Go out there and use these rules to make some profit in your stock market portfolio. I appreciate you being here in a major way. Thank you so much. Have a great night.